So, Enphase just dropped its latest earnings, and really, the big question on everyone's mind is this: have they finally hit bottom, or is this just a flash in the pan? Okay, let's dive in and unpack what was one of the most explosive earnings reactions we've seen all year.
And I mean, the stock didn't just climb, it went vertical. We're talking a nearly 38% jump in just 24 hours. A move like that, yeah, it gets your attention and it demands an explanation.
So what's the deal here? Was this some kind of fundamental shift for the company, or was the market just caught completely flat-footed? We are going to break it all down.
All right, here's how we're going to tackle this. First, we'll look at the headline numbers. Then, the story management is telling. We'll also cover the risks that are still very much in play. Then we'll get into the investor context, where the stock was coming from. And finally, we'll wrap it all up with our own call on what happens next.
Okay, let's kick things off with the numbers that started this whole firestorm. How did Enphase actually do compared to what Wall Street was penciling in?
Now, the Q4 results, they were good, don't get me wrong. A solid beat on both earnings per share and revenue. But honestly, that's not the real story here. The big surprise, the thing that really lit a fire under the stock, was the guidance for the next quarter. Their forecast of $270 to $300 million absolutely blew past what people were thinking. And that sent a huge signal that, hey, maybe this recovery is happening way faster than anyone thought.
And that stronger guidance really set the stage for this powerful turnaround story that management started telling on the earnings call. And believe me, investors were listening.
This right here, this is the quote that really moved the needle. The CEO, Badri Kothandaraman, he didn't just hint that things were getting better. He came right out and called the bottom. You got to understand, for a stock that has been absolutely hammered, hearing that kind of confidence, well, it's exactly what the bulls were dying to hear.
And he didn't just say it, he brought the receipts. Management pointed to a 21% jump in U.S. product sell-through from the last quarter. Batteries? Even better, up 27%. And they mentioned that inventory out in the sales channels is getting pretty lean. That all suggests that real, underlying demand is starting to wake up. Plus, they're being smart about it, cutting about 6% of their workforce to keep costs in check. But it's not just about the short-term rebound. They painted a picture of longer-term growth, and it's all about innovation. We're talking a brand new next-gen battery that's way more powerful and cheaper to build. And then there's the IQ9, a new microinverter that cracks open a whole new $400 million commercial market they weren't even in before. And get this, it's not just a blueprint. They've already booked over 50,000 orders for Q1. That shows this thing has legs. Okay, but let's pump the brakes a little. Before we all get too carried away with the good news, it is really important to look at the other side of the coin, because the story isn't all sunshine and rainbows. First up, Europe. While the US is looking better, revenue over in Europe just fell off a cliff, down a whopping 29% from Q3. That is a huge market for them, and you just can't gloss over that kind of weakness. And then you've got profitability. These reciprocal tariffs, they're a real problem. Management said they took a 510 basis point hit to their gross margin in Q4. To put that in plain English, that's a 5.1 percentage point haircut right off the top. That's a serious ongoing drag on their bottom line. So this really sets up the battleground, right? You've got the bull case, which is all about the US recovery and this awesome new product cycle. And then you have the skeptics view, which is basically saying, hold on, what if the US solar market is in for a longer-term slump? And what if Europe just doesn't get better? Now, to really get why the stock exploded by almost 40%, you have to zoom out a bit. It's not just about this one report, it's about where the stock was before the numbers came out. And this chart just says it all, doesn't it? In the year leading up to this report, Enphase stock had cratered, down almost 42%. Meanwhile, the main solar ETF, TAN, was up over 67%. That is a massive, massive divergence. It tells you that sentiment was in the gutter, expectations were rock bottom, and a ton of people were probably shorting the stock. It was basically a coiled spring, just waiting for any reason to pop. All right, so that brings us to the final piece of the puzzle, the next call. We've heard the bull case, we've heard the bear case. So what do we think happens from here? Let's get into our prediction. We're going to break this down for you in 3 simple parts: what we expect from the next quarter's results, how we think the stock will trade, and finally, our official rating. Okay, first, the Q2 results. Our call is that they're going to beat the high end of their own guidance. Why?
Well, that U.S. recovery seems to have real momentum. And we think you'll see some safe harbor activity, where developers buy up equipment now to lock in tax credits for future projects. That'll be another nice little tailwind.
As for the stock itself, look, after a jump like that, we expect it to cool its jets a bit, consolidate these huge gains. It's just natural. But expect the volatility to stick around. The market is going to want more proof that this recovery is the real deal before it commits to the next leg up. And that brings us to the big one, our rating. We are officially rating Enphase as outperform. Now, are there risks? Absolutely. Europe is a mess and the tariffs are a pain. But right now, we believe management's confident call that the worst is over, well, it's credible. It's backed by real data in the US and a killer new product lineup. For us, the risk-reward has definitely shifted to the upside.
So, there you have it. That's our breakdown of Enphase's wild quarter. And as always, a quick reminder, this is not financial advice.